Will the stock market finally start to turn around? That's an interesting question, and I'll offer some insights into what's happening right now. The markets were very tentative and unpredictable this past week. So what's going on? Well, let's take a look at the metrics to find out. So if we look at how the markets performed this last week, it really kind of doesn't look very good at first glance. You've got ARK Invest and small caps, both with negative returns over the past week. But on the other hand, the NASDAQ 100, the S&P 500, and the Dow were all up for the week. This is kind of a strange look. Well, maybe not if we stop and think about why this is happening. Look, the Fed has indicated they're hesitant to start lowering rates. They just raised rates again. And everybody who values companies puts the risk-free rate in the denominator of the value equation, meaning higher rates means lower values, especially for smaller companies. And if you look at ARK Invest Innovation, most of these are fledgling innovative companies. If you look at small caps, obviously they're smaller companies. So the market is punishing small caps and ARK. It's actually rewarding the NASDAQ, where these companies are large cap companies, so they're not as affected by increasing rates as the smaller companies. And if we look back over the past month, you can see a very similar situation. Small caps have absolutely been trashed. ARK is not doing well. The Dow and the S&P aren't doing well, but the NASDAQ is performing very well. This tells me there's an appetite for risk, but only so much. And over the past 6 months, you would think this market would be terrible given what we've been seeing. But if you look back over the past 6 months, all of these are up. You can see that here. This really isn't all that bad. When we look at the current bottom dynamics, it's kind of an interesting picture here because we had a bottom forming indicator back here, a very brief one. And now where are we? Well, now where we are is confidence level is shooting up as the market moves higher. And you can see this bottom confirmation indicator is shooting higher. This tells me the market is likely to go higher from here, but there's no guarantees. I do like what I see here, though. This looks promising. And what about risk versus opportunity? Well, you can see we had risk acceleration way up here above 90. This is crazy high, very risky. And risk, the red line, was up here in the mid 80s. These are both very, very scary numbers. But now you can see what happened is risk acceleration just plummeted here and has been bouncing around. And the risk itself is declining overall. While this looks a little bit scary, I think the markets are kind of trying to sort of figure themselves out and figure which way they're going to go from here. What about equity versus safety? If you look at equity versus safety, we had an unhealthy Treasury market back here on March 3rd. Gold was ranked very high. Cash ranked number 1. You definitely don't want to see that. But what was interesting is small caps and the NASDAQ 100 were the best performers of the equity bucket. Then on March 10th, we had a very healthy Treasury market, but an unhealthy looking stock market, except that the NASDAQ equities were ranked number 1. This tells me there's a flight to safety here, and cash was still in the top group. Then a week ago, gold at the top, healthy Treasury market, but the NASDAQ 100 was creeping up here. Because why? Because it's been performing well. But the rest of the equities were still down here at the bottom. Now, where are we as of this past Friday? Well, this past Friday, the NASDAQ 100 is ranked number 2. We still have a healthy-looking Treasury market with longer duration Treasuries ranked the best, and then cash is down here. And I like the fact that cash is down here. I'd like to see it fall even further. But then we also have the S&P 500 sort of moving up a notch here. So this is starting to look better. Not great, but better. And how does this show up in the buying and selling pressure? Well, you can see we had a huge spike in Dow Jones Industrial Average selling pressure back here, and then it's been tapering off as this has been trying to move higher. And the S&P 500, similar picture, big spike in selling pressure, and then as the index has moved higher, the selling pressure has been in decline. This looks good. NASDAQ 100, the best performer of all of these, as you can see, the price just rising like crazy here, and the buying pressure above the selling pressure We'll have to see where this goes from here, though. And the Russell 2000 has been the worst performer of the bunch. And you can see the selling pressure just was through the roof here as this fell. And now selling pressure has been declining, but the price has continued to decline. Maybe this means we're going to see a turnaround in small caps. We'll have to wait and see what happens in the next couple of weeks. And ARK Innovation trying to have a rally here. You can see the buying pressure was above the selling pressure, and then that flipped in the last couple of days. The sector rankings tell an interesting story when you put it together with all of these other metrics. So if we look at sector rankings, you can see Bitcoin and semiconductors are ranked 1 and 2. These are risky areas to invest in. Technology, XLK, ranked here number 5. The Qs, the NASDAQ 100, ranked here. This looks very, very healthy from a risk standpoint. Investors are putting their money in riskier assets here. Emerging markets. This looks great. Consumer discretionary, just slightly doing better than consumer staples. I'd like to see it doing a lot better, and I'd like to see cash moving over here to the right. We're not there yet, but this is starting to look good. And how does it look if we look at sector rank acceleration? Well, when we look at sector rank acceleration, these move much more quickly because we're looking at the change in the rankings. So again, Bitcoin, NASDAQ 100 way up here, consumer discretionary right up here near the top, technology sector right here near the top, ARK Innovation near the top, consumer staples down here, and cash here. Now, I'd like to see consumer staples and cash move way to the right. Hopefully this trend will continue and that's what will happen. But we're not quite there yet. It looks good, but we're not quite there yet. And how have Treasuries performed over the last week? Well, you can see that the riskier Treasuries, since they bottomed here, have been moving up more dramatically than the less risky Treasuries. This is starting to look like a healthy Treasury rally. And I'm really happy to announce that the inverted yield curve has really moved toward being not inverted. Now, we're not there yet. We're still almost 40 basis points away, or 0.4% away from being not inverted. This line has got to get up here to 0 or above to be not inverted, as it was back here a year ago. So you can see back here it was well above 0, and now it's 40 basis points below 0. So we're still inverted, but we're not as inverted as we were just a few weeks ago. And how inverted were we? We were over 1%, 1.1% inverted. That's crazy. And you can see that it's shot up since then, and we're now just about 40 basis points inverted. And when we look at buying selling pressure for the Treasuries, you can see intermediate Treasuries, the buying pressure has been well above the selling pressure until recently, and we've had a very nice price move upwards. 7 to 10-year Treasuries, what I call intermediate to long Treasuries, again, a very nice upward move in the price. The buying pressure really spiked here, and then it's been kind of just trading places back and forth here with the selling pressure. And what about 20-year long bonds? Well, again, nice move up in price and a very strong buying pressure here and still continuing to move up. This looks very good. How about gold? There's been a run to gold with all the banking contagion that's going on, and you can see that the price of gold has been moving up very nicely. The buying pressure has been moving up very strongly. So gold looks like it's a good place to be for right now. And Bitcoin's been an interesting move recently because with all the banking contagion, people are starting to think, well, maybe there's a really good, valid reason that we should be using blockchain instead of keeping our money in banks. The blockchain has been working flawlessly through all of this banking difficulty. And you can see the price of Bitcoin is moving higher, and the buying pressure has been trending higher very nicely. This looks great. Look, there are clearly still risks ahead in the form of potential bank failures, the latest worry being Deutsche Bank. Now, will Deutsche Bank go under? Probably not. I'm sure the European Union will step in if there really is a problem there, but this really freaks people out. It seems, and I'm hoping, the Fed is finally starting to recognize the damage they're causing. Does this mean they'll stop raising rates, or better yet, start lowering them? If their recent actions are any indications, the answer is no. They've raised rates by more multiples than ever before in history, so I don't expect them to get smarter overnight. The metrics continue to show signs of improvement. So this past week we went long with the cash we were holding in our clients' accounts. That being said, we remain very vigilant and a little bit on edge as we move into the spring weather and hopefully better weather for the markets. I'm Calvin Rose, and thank you for watching Invest Smarter this week. That's all for now.
Pour it out, if I'm being honest.
All right, how we looking? As good as you can, I guess. Oh boy.